Welcome to another edition of Wicked Problems. Today, I'm joined by Jannah Patchay, subject matter expert and consultant in the financial markets sector. Jannah specialises in financial markets innovation and helping firms define, develop and execute commercial strategies in a highly regulated environment. Her passion is for market structure and finding creative solutions to the challenges surrounding access to markets and liquidity for both traditional financial markets and asset classes and the emerging field of digital asset market structure and regulation, the subject of today's show. Jannah has assisted in the launch of new trading venues, business products, services, interpreting and implementing new regulations, and advising on regulatory, business, and operational strategy. She is a founder member and regulatory advocacy ambassador for the London Blockchain Foundation and a freelance journalist for Best Execution magazine, where she regularly covers financial innovation topics. Jannah Patchay, very nice to have you on Wicked Problems. Thank you so much for joining us.
Thank you for having me, Toby.
Coins, by which I don't mean metal hunks that live in your pocket, but the digital variety. I think a lot of people know what Bitcoin is, even if they don't really know what it's for. But there's all sorts of other coins, and I think you've been working with all sorts of different digital currencies and assets, haven't you? And I'd love to hear more about it.
Yes, I have, and I tend to work more on the regulated end of the spectrum. So less your cryptocurrencies, and I'll give you a quick breakdown of the different types and the ones that I'm focused on in particular. And then perhaps we could have a bit more of a discussion on the particular problems that some of these things can solve.
That would be fantastic.
What's required to take them forward and create a more modern and digital economy.
Excellent. Yes, because I think lots of people really don't have that much understanding of how these different stable coins or different tokens can actually help. Well, what problems can they address and how do they do it? So that would be really excellent.
So I'll start by giving you a bit of some background to the world of digital assets and digital currencies and why it is that they are so inextricably linked to technologies like DLT, distributed ledger technology, and blockchain. And the reason behind this is, so in the early days of the internet and file sharing, you could create a digital representation of something. So you could create a digital representation of a music file or something like that, an MP3. And you could stick it on the internet and you could share it. And anyone could take a copy of it and download it. And multiple copies would then be in existence. And so you can see why this would be a problem where you only want to have one copy of something ever. So where you want a limited supply and where you want that supply guaranteed. So in the case of currency or securities, things like that, that early stage of internet and file sharing wasn't really well suited for this. And what distributed ledger technology and blockchain in particular brought us was the ability to create something unique that was cryptographically protected and that could ensure the uniqueness of an asset and could also ensure that it could be tampered with. Because DLT, and I'm not going to go into the way that DLT and blockchain work at the moment, but because of the way that these technologies work, they are consensus driven. So there has to be full consensus on any action that is taken with respect to them, any transfer of ownership that's made. And because there's only one copy of any of these assets at any point in time, that means that its ownership can only be fully transferred. It can't be copied and duplicated. So it's that technology paradigm that's led us to the point where we can actually create digital currencies and digital assets whose ownership can be fully transferable. And then when we talk about digital currencies in particular, most people tend to think of cryptocurrencies like Bitcoin and Ether, which is on the Ethereum blockchain. So I tend to think of these as the native cryptocurrencies. And again, we're not going to go into too much detail on them on this podcast because they're much better off discussed by the true experts in these areas. They are the cryptocurrencies that basically enable the functioning of an underlying blockchain. And they have, in many ways, they behave more like a native currency themselves, but they have their own issues and their own use cases out there. What I am going to talk about is the ability that distributed ledger technology and the blockchain gives us to create other types of digital currencies and other types of digital assets and the problems that those can solve. So, shall I get started on that?
Yeah, so just before we do, though, I mean, I think you were talking about we wouldn't delve into Bitcoin and Ethereum and or the Bitcoin blockchain and Ethereum and so on, because obviously you called them native, I think, and there are other people who maybe are deep experts on those things. But as I understand it, they kind of rely on a kind of proof of work and they reward people. And what we're talking about here are maybe different mechanisms for achieving that transferable capability with but that it's an asset that's on a ledger.
So the key difference between a native cryptocurrency and a digital asset or a digital currency that sits on top of a blockchain or a distributed ledger are that the native cryptocurrency enables the technological functioning of that underlying blockchain itself. So Bitcoin, the mining of Bitcoin, is actually an intrinsic part of the operation of the Bitcoin blockchain. Similarly, with the mining of Ether, that's an intrinsic part of the operation of the Ethereum blockchain. The blockchains themselves then give you the ability to build functionality and digital assets on top of them. So, and these can be to some extent technology agnostic as well. So we can talk about distributed ledger technology as distinct from either of the main blockchains or any of the blockchain implementations out there. And we can talk about the type of assets that we can then create and build that and put them on top of those distributed ledgers. And so that's where your digital assets and other digital currencies come into play.
Thank you for clarifying. I think it's just important because there'll be people listening who maybe don't know the differences, and so it's great. Thank you.
Okay. So with respect to digital assets, what we now have the ability to do is create what's known as tokenized representations of underlying assets or tokenized assets themselves, and have them operating in a fully digital manner on a distributed ledger with full transfer of ownership. And this is actually very powerful. What it gives us the ability to do that we weren't able to do before is have instantaneous settlement for a start. So if you trade a digital asset, if you have a buyer and a seller exchanging a digital asset on a blockchain, there's no need to go through a multi-tier settlement process, for example, because these are fully digital assets. So you can have, for example, a security token, a tokenized equity share in a company, have one party sell it to another and have that instantly settle on a distributed ledger without the need to go through layers of intermediation all the way down to CSD or anything like that. Now, there are some regulatory challenges there because obviously from a regulatory perspective, these kind of infrastructures still exist. But the industry is working with the regulators to overcome some of those and stop some of those barriers to instantaneous settlement. So
this kind of helps, I guess, in this situation where if I bought shares and then I sell those shares, I on some platforms I might have to wait 2 or 3 days before the money that I've made from that sale is actually available to me, or it's only available to me as a credit and then it's at risk because it's a credit.
Exactly. And then you're exposed during that time to counterparty risk and to settlement risk as well in the event that your counterparty is not able to deliver or that the transaction doesn't settle.
Yeah.
And all of these, especially in the world of financial markets, create additional costs, create additional operational overheads, because the full settlement life cycle and chain is obviously quite difficult and expensive to maintain as well. And at the moment, with respect to more complex securities, you've also got life cycle events that occur over time, many of which need to be managed through layers and layers of technology infrastructure, operations teams, and things like that. Whereas if you have digital assets, you can then also combine those with smart contracts to actually automate many of those post-trade events and corporate actions and operational processes. So this creates a real opportunity in financial market space to reduce costs.
These would be things like a share split or a rights issue or a dividend or that sort of.
Exactly. Yes. Yeah. Okay. Yeah. So in terms of digital assets, we can tokenize absolutely anything. So you can tokenize anything that exists currently in the financial market space. You can have tokenized equity issuances, tokenized bond issuances, and this gives you the ability to rapidly create a product, do the initial issuance and distribution, and then have a secondary market. Obviously, you still have all the challenges that are inherent in building a liquid secondary market around those, and we can get onto that in a minute. But then you also have the ability to, as we just said, to automate all of the post-trade events that are associated with that, and that's the really powerful part as well. And you can build into the smart contracts that govern these regulatory requirements, ESG principles, all sorts of things to ensure that the trading of them is actually conducted in a regulated manner as well. So it's quite a powerful technology overall, and one that really does have the potential to change the way that financial markets infrastructure operates.
And what's the adoption rate like of these things? Because it sounds like it's almost a no-brainer, really.
So the adoption rate at the moment is highly variable depending on jurisdiction. We started off and it's now a dirty word, a dirty phrase almost to say initial coin offering, but this is where this all really started. A few years ago, we had lots of smaller companies trying to raise funding for their projects by doing what they called coin issuances, and they would basically invent their own digital currency in inverted commas, stick it on top of a blockchain, and sell it to investors in exchange for some highly dubious stake in their highly sketchy project or enterprise. And there were enough of these that regulators took a real fright and started cracking down. And then we saw the next evolution of the market, which was where serious market participants started looking at these structures and saying, okay, so the ICO, initial coin offering concept, is sketchy as it's currently implemented, but we could actually take this and turn it into a tokenized security, have all the regulatory controls around it, and use the same concept to more fully digitize the financial markets infrastructure that we have now. And so this next stage of the evolution really kind of kicked off towards the end of, I'd say, 2018, beginning of 2019. In the UK, the real milestone was the Financial Conduct Authority's consultation on crypto assets that it published in January last year. And it basically said, we're not going to look at these in terms of being crypto assets or digital assets. We're going to look at what they would be if they weren't on a blockchain. And if you strip away the technology, actually what you're left with is something that looks and feels and behaves like a financial instrument and should therefore be regulated as one. And this gave the regulatory certainty that market participants needed in order to start more more openly investigating the uses of these. So in terms of adoption rates, I'd say that, as I said, that's been quite variable depending on jurisdiction. So we've had higher adoption rates in general in the US, where the SEC has been more focused on providing guidance around these. In the UK, there are a few regulatory and legal barriers to their implementation that are more due to legacy considerations. So it's not really about, it's about our legal system and our regulatory system not being fully fit for purpose when it comes to things like intangible assets. So things that aren't backed by pieces of paper, for example. We're still very paper-based in our legal system at the moment. And these are being recognised and they are being overcome. And there's a lot of work going on in the legal industry and with regulators to start dealing with some of these challenges. And this is going to open up greater adoption as well. And I think people don't always realise exactly how much work is going on in the space. So, for example, ISDA, the International National Swaps and Derivatives Association, has done a huge amount of work in finding a common domain model for describing derivatives contracts. And what that gives you is a framework for describing and digitizing derivatives contracts that can then be implemented in DLT-based systems. So there's a company in the US called Advocacy that took that CDM work for equity derivatives and has actually created an entire DLT-based post-trade processing platform for equity derivatives that has 15 banking participants working on it, live on it at the moment. And so once an equity swap, which can be an incredibly complicated transaction, is executed, then it's entirely managed on a distributed ledger, and there's no need for human intervention in any post-trade events or anything like that at all.
It sounds like there's a great opportunity there, as you're talking about, for reducing timeframes for trading and settlement, clearing, all of that sort of thing, and regulatory oversight and the ability to report things back into the regulators. And I'm wondering if it's also has the potential to drive through price transparency as well.
Absolutely. I think by reducing the number of intermediaries that are involved in the end-to-end transaction, you have a huge opportunity to reduce prices for end users. And again, this is going to be very different depending on what part of the market you're looking at. In the derivative space, obviously, these are instruments that are usually used for risk management by large corporations and financial institutions, and there are opportunities there. But in the in traditional equity and debt capital markets as well, there's an opportunity here as well to create more efficient means of transferring capital across markets and internationally as well, because of the ability to build in regulatory requirements, the ability to tap into cross-border markets and things like that. And some of the legal and regulatory frameworks, again, don't exist to do this cross-border today, but there's a lot of work being done to do so. So the idea is a company could come to market in London, do a security token issuance that's facilitated by a smart contract, that's then able to figure out all the international regulatory requirements that are needed in different jurisdictions, and then be able to tap into investors globally, whereas at the moment you've got to go through layers of intermediation in order to access that global capital. But I know we wanted to talk about stablecoins and digital currency as well.
Definitely do, yes.
And so when we talked about the challenges to adoption in digital assets, this is where stablecoins at the moment really come into play in digital currency longer term. So when at the moment, when you settle a transaction, so say you've got an equity transaction, when you settle it, the settlement is basically the exchange of the equity side of the transaction for payment in cash. And it's when you have a tokenized equity or security token transaction taking place on blockchain or a distributed ledger, that side of the transaction is instantaneous. But what about the cash side? Because if you're exchanging payments in cash, in fiat currency as we have it at the moment, so dollars or sterling, that side is still going to take the 2 days that settlement in a fiat currency takes right now. So what we then saw was a number of startups starting to offer stable coins, which are coins that are linked to whose value is linked to an underlier, basically. So you can create a stable coin such as Tether, where a one USD Tether is equivalent, in theory, to $1. And then that stablecoin is basically a tokenized representation of an underlying currency. And you can use that to settle your transaction. But again, that Tether coin is issued by a company called Tether, and they are themselves responsible for ensuring that there's a one-to-one mapping between that dollar Tether and the underlying Tether.
Well, how do they do that? So they actually have a load of dollars sitting in a vault somewhere? Or how's that work?
Well. So this was actually a big question about Tether for quite some time. And recently they have started saying openly that it's not necessarily fully collateralized by US dollars. It's maybe asset or synthetically backed as well.
Okay.
So this exposes the holder of any of these stable coins to counterparty risk again, which reintroduces a problem that we didn't want to have in the first place. And it is to counterparty risk from a party that they didn't even want to be exposed to necessarily in the first place.
It smells a bit like the risk that you get from leverage, if it all goes well for you, then great. And if it doesn't, that you could be in a world of pain because actually you can't get your hands on, you've lost a load of money that you didn't even have in the first place. In terms of that, So,
except in this case, nominally you do have this money, and you decided to buy USD, Tether, or other stable coins in good faith to affect the settlement of your security token transaction, but you now find yourself exposed to the counterparty risk of the Tether or other stablecoin issuer. And I use Tether as an example. It's actually a highly reputable stablecoin in itself. Many smaller issuers are now, in order to carry out the projects and build out the technology that they want in security token issuance and security token platforms, they are actually starting to issue their own stable coins in order to effect settlement. And so we have this fragmentation of different coins and also again, this undesirable reintroduction of a certain degree of counterparty risk. And this is where central bank digital currency comes into play, because ideally what you'd like is for your cash leg to actually be backed in the same way as fiat currency is by a central bank. And this is the next step in the evolution of digital currency to some extent, is central banks actually issuing their own digital currency, which can then be used for the settlement of these transactions.
Okay. Sorry, can I just ask a question? Because central banks, I mean, the Bank of England doesn't. I mean, I know it has got a lot of ingots and whatever, but it's not really, if we said, for example, just to make the numbers easy, there's $100 trillion pounds. There aren't really $100 trillion pounds sitting in the bank. It's all digital anyway, isn't it? Well, not a large percentage of it is digital, but in a different sense, in that it's not on a ledger, or a digital ledger in the way that you're talking about.
It is. So at the moment, you're quite right in that currency is digital right now. The money that you have in your bank account is a digital representation. The bank isn't sitting there with vaults full of cash backing every account. The Bank of England doesn't have vaults full of cash backing everything either. These are digital representations, but they are still flowing through a payments infrastructure that's designed based on the notion that of cash, basically. And what digital currency gives you the ability to do, or if you're a central bank, is actually distribute currency directly as though it's natively digital. So rather than going through the current processes, you can, for example, create accounts for individuals or businesses that are backed directly by central bank funds.
So let me just see if I've understood something here. We currently have a process that is digital, but has been designed around a process that wasn't digital, and that creates blockages and delays and so on, because we think we're picking up pieces of paper and giving them to other people, and they've got to walk down the street and give it to someone else, and all of the rubber stamping and so on that would happen in that real world process if it was actually paper-based. So we have that digitalized, but what we don't have is a digital process that's designed for a digital world.
That's exactly the problem statement, Toby. Yes, that much of the payments infrastructure that we have out there, the settlement processes that we have, these are all designed based on the original underlying principle of a paper economy. And everything that's happened, I mean, they've obviously evolved quite a lot, and there's been a greater move towards digitization. These are now, highly technology driven and automated and things like that. But they're still based on some underlying principles and legal assumptions around what money is. And so we're not, as countries are not necessarily fully able to take advantage of truly digital economy and truly digital provision of services, because they're still operating on some very outdated underlying principles.
So, I mean, it just seems like wow, really. But I want to ask you a question about a stablecoin that seems to not have happened, but we've made a lot of news about. I don't know if I can't remember if it was a year and a half or a year ago now, which was Facebook's Libre. A lot of noise, a lot of companies saying that they were getting behind it, and then suddenly a lot of companies dropping out of it. And I'm just wondering what happened, and if you even know. Maybe you don't know.
So Libre is very interesting. I actually did a fair bit of analysis and wrote a fair bit about Libre at the time. And you're right, it was around last June that the first Libre white paper was published. And what really interested me about Libre was that it seemed to have been designed by a group of really clever, geeky people who knew nothing about payments or financial services or regulation, but were sitting in a room together and came up with what they thought was a very good idea. And then as soon as they started taking it out there to the general public, to regulators, etc., and to governments in particular, the cracks very quickly appeared. So Facebook's Libre was originally designed to basically be a sort of stable coin and a means of payment that you could then use to pay for things via Facebook platforms, other platforms as well. And it was supposed to be backed by a basket of underlying currencies and short-term notes and things like that.
So a bit like Tether.
Well, except this would be a whole basket of different currencies. So you could have dollars in there, you could have sterling, you could have some, short-term government notes and things like that. You could have some, short 1 week, 2 week on-the-run bonds and things like that as well. And from a financial services perspective and from a regulatory perspective, it wasn't really well thought through, because what you're actually talking about was less a currency and more a fund, almost a fund that you would want to keep the value of stable every day. So you would be rebalancing this thing multiple times a day and buying and selling the underlying currencies. And Facebook is huge. So I think it's got about 3 billion users at the moment. So it obviously has the global reach to mean that take-up of Libra would have been huge as well. And if everyone on Facebook had taken up Libra and used it as a means of payment, and these rebalances were happening daily, then actually you'd have quite big shifts potentially in how, as the value of the dollar fell, then, you might be trading out of the dollar or, buying sterling or something like that. And this is where central banks and governments started panicking, because what Facebook were proposing was something that could actually move their currencies. And that was certainly problematic. From a regulatory perspective as well, the fact that they were creating something that was meant to be used by anyone in any country without really understanding all the cross-border regulatory issues, the fact that this isn't a currency, given it's more like a fund, it's a financial instrument, and therefore it's governed by all the most challenging bits of regulation, like MiFID in Europe and things like that. That was always going to be a blocker.
Isn't there an issue, though, also around the fact that if you've got somebody like Facebook who's got that global reach, I can see two potential issues. One is, well, it kind of eats into the sovereignty of the fiat, or even if it's a digital currency that's native to a particular country. And then the other problem is trust. And I bring up the trust question because obviously Facebook has had the whole saga of trust applied to it around elections and around data sharing, Cambridge Analytica, etc. Would people really trust an entity as big as Facebook? And I'm not really pointing the finger at Facebook and saying you're bad people, but when companies become very, very big, it seems like there's a trust actually decreases at some level.
Yes. So I think there's also a financial inclusion aspect here. So we in the UK are mainly quite privileged in that we have access to bank accounts and other payment methods, especially for cross-border transfers. We have things like TransferWise and other platforms that allow us to do these things quite efficiently. And we have as a society, in the UK, we have a higher regard for individual privacy as well. So Facebook's breaches of privacy bother us. In much of the rest of the world, those considerations may not be that significant. If Facebook is offering a really cheap way to move money across borders, to do remittances to family and things like that, and you don't even care really right now what they're doing with your data, then why would you care in the future? It's all about that trade-off. For the convenience that you get and the accessibility, the fact that it's potentially built right into the social media platform that you currently use. But you're right about the sovereignty angle. And when we look back to when the discussions about CBDC really heated up amongst governments, it goes back to Facebook's announcement of Libre, because this suddenly gave many governments the impetus to sit up and start taking it seriously. Like, if I don't get there quickly, then a private entity is going to do that, and that's going to potentially introduce a world of pain and lose control over not only sovereignty, but a degree of control over the flow of money in my economy if it becomes big enough. And again, with Facebook, it's big enough. So Facebook has now relaunched Libre. So it published a new white paper, which is considerably toned down. It's now proposing a number of single currency stable coins. So going back to the example I gave earlier of Tether, it's looking more Tether-like. So there'll be a US dollar coin, a pound, a sterling coin, etc. And they are still proposing a Libra coin, which is based on an underlying basket, but it's hugely simplified and meant more for those countries that for which there isn't going to be a coin tied directly to their currency.
Yeah, okay. It's one of the key reasons that we have, one of the functions, I should say, of any currency is to act as a driver for tax revenues, right? And so I have control over how much I pump into the economy or don't as a government, and that affects the value of my tax receipts at some level. And if that control is taken away from me, then I don't have that capability anymore. So isn't there a threat, to sovereignty from that angle with something like Libre?
Yes, I'd say that's not an unfair characterization. There were many people who saw Libre as potentially the first step by Facebook to actually creating more of a banking and financial services presence, because once you started collecting data on users' spending habits and their transactions, etc., then it's much easier to design financial products for those users as well, and to create your own actual banks and bank accounts and things like that. And while those would need to be regulated in certain jurisdictions, if there's sufficient flow of stuff across Libra coins and the Libra platform, then yes, you're right. There may then become some kind of shadow payment system through which the governments wouldn't have visibility of all income or revenue generation that was taking place in their economy, and that could potentially, especially in some countries where the shadow economy is more prevalent, create some serious challenges to their ability to raise revenues.
And we're not long left on our time, but what I'd really like to just ask you before we do wrap up, we talked about the fact that these stable coins and these digital ledgers have the capability for solving a lot of problems. So you talked a little while ago about, in countries where you don't have, a large percentage of the population that perhaps are unbanked, and then, these things can act as a great enabler for banking for those people, because they can transfer these coins around, maybe using a mobile or whatever. COVID-19, we've seen a lot of reverse flows of money. Rishi Sunak, the Chancellor here in the UK, has done an awful lot of sort of quantitative easing, but also, opening up a distribution of funds to various types of people in different ways. But one of the criticisms has been that's taken, maybe a little bit too long for some people. If you are poor and you're having to wait for that money to come through, and you're having to wait 2.5, 3 months, that's maybe 2 months too long. How would a distributed ledger, a digital currency, a stable coin help, or would it, but with something like, distributing funds during a time like COVID-19 to where that fund needs to be?
So that's a really good question. And it's one of the topics that is driving a lot of discussion around central bank digital currency adoption in the UK at the moment. The fact that the system that we have at the moment is not very efficient when it comes to the government distributing funds and value to end recipients. It's set up to facilitate payments between entities, but not distribution of funds. So if we look at, for example, the CBILS, the Coronavirus Business Interruption Loan Scheme, and the Bounce Back loans, one of the challenges with those is all the participating banks actually required companies to bank with them. So especially for small to medium enterprises, you would have to leave your current bank if they weren't on that list and open a current business account with one of those lenders, which is quite anti-competitive. In terms of distribution of funds to the self-employed, or even distribution of funds to those individuals and families who are most in need, the government relies on the fact that people either have bank accounts at the moment, and then where exactly, how do you obtain all those bank account details very quickly if you don't have them, if they're not already on the register somewhere? Or also the distribution of prepaid cards, which have their own inefficiencies as well. If we had a central bank digital currency where every citizen and every company could then have their own CBDC accounts directly with the central bank, then it would be much, much easier for the government via the central bank to immediately distribute funds to those who need it.
Right. So there's almost a driver coming out of this COVID-19. Who knows how long it's going to take us, but as we sort of readjust towards, that kind of fuels the debate and the direction of travel, really, doesn't it? And makes the case for more of these digital ledger, stable coin, digital currency, etc., so that we have that available, that utility available to us if and when, and let's hope we don't get another one, but if we do get another a COVID-20, then we can react more quickly and help people before they get trapped by, poverty traps, I guess.
Absolutely. And I wouldn't necessarily lump stable coins in the same bucket as central bank digital currency. I think when you're looking at monetary policy and at central banks, this is not about stable coins. Stable coins are currently a means to an end for some use cases right now, and to some extent when it comes to payments and settlements, stable coins exist to solve a problem that's caused by a lack of central bank digital currency. But central bank digital currency could give governments not only the ability to better distribute funds and provide more resilient financing solutions in the future if there's other types of crises, but also they could stimulate greater innovation as well. So when, going a bit more out there, when we look at the Internet of Things and at services that can be provided by, devices and things like that, having a central bank digital currency could more effectively enable payments for those, could, generate greater innovation in the digital space and things like that as well.
Jannah, it's been a really fascinating conversation. We could go on, and there's so many more aspects of this that we could talk about: fraud, anti-money laundering, settlement, wholesale versus retail, privacy. So many things. But sadly, we don't have the time. But maybe we could do a follow-up at some point. One question before we go: if people do want to find out more, there websites they can go to that you can recommend, or other resources?
It's going to depend exactly on exactly what they'd like to find out about. I think central bank digital currency is a very hot topic at the moment. There's actually a Bank of England discussion paper on retail CBDC that's out at the moment. So if you just Google Bank of England and CBDC discussion paper, that'll turn up that result. In general, there have been some very interesting papers published globally by other central banks as well on CBDCs and their implementations. The FSB has recently published some guidance to the Financial Stability Board on the regulatory treatment of stablecoins, which doesn't say dear Facebook and dear Libre on it, but might as well. Yes, I think there are a number of resources out there. So,
and if people wanted to learn more about the work that you do, where could they look?
They could have a look at my LinkedIn profile, which I would say my company website, but I don't yet have everything on there. So I do a lot of writing in this space as well, some blogging and freelance journalism, it's all on my LinkedIn profile.
Great. Thank you, Jannah. That's been most interesting.